Welcome to The Explainer. We trust banks with pretty much everything: our paychecks, our savings, all our biggest financial decisions. But have you ever stopped to think about what a bank really is? Today, we're going to pull back the curtain on this institution we use every single day and see what truly makes it tick. I mean, it seems so simple, doesn't it? You put your money in, you take your money out. But the moment you make that deposit, your cash kicks off this incredible journey. It connects your savings to the huge global economy in ways you probably never even imagined. So let's follow the money. All right, here's how we're going to break it all down. First, we'll cover the bank you think you know. Then we'll get into the bank's business model, how they actually make money. After that, we'll explore the two very different worlds of banking, look at the system's guardians, and finally tie it all together to show you why it all matters. Okay, let's jump right into section 1, the bank you know. Before we get into all the really complex stuff, let's just get on the same page with a simple core idea. At its heart, what is a bank? So at its very core, a bank really has two main jobs. First, it takes in deposits from people like you and me. That's your checking account, your savings account, the money you can demand back at any time. And at the exact same time, it's making loans. That's it. It's this constant flow of money in from savers and out to borrowers that makes the entire system go round. And believe it or not, this basic idea is super old. We're talking way back to merchants in Renaissance Italy who would do their deals on benches. The Italian word for bench is banco, which is where we get the word bank. Kind of cool, right? From there, you had London goldsmiths who started lending out the gold people were paying them to store. Then it took a huge leap forward with the first central banks. And now, of course, technology has turned it into the massive, global, digital system we all use every day. Okay, so we've established that banks are basically just moving money around. But how does that simple function turn into a business that makes, well, a ton of money? Let's get into the business model. So if you really want to understand how a bank works as a business, you've got to look at two key things. First is its balance sheet. Think of it like a snapshot in time of everything it owns, which are mostly loans it's made, and everything it owes, which, by the way, includes your deposits. Then you have the income statement, and that shows how all that owning and owing actually makes them a profit. And this is really the secret sauce to the whole operation. It's called the interest rate spread. So let's say a bank pays you, 1% interest on the money in your savings account. Then they take that same money and lend it out to someone else for a car loan at, say, 6% interest. See that difference? That 5% gap? That's the spread. And that is the number one way a bank makes its money. It sounds simple, but when you scale that up across millions of customers, well, it becomes a huge, huge business. Okay, now this is where banking gets really wild. If you look at a normal company like a factory that makes widgets, it might be funded with about 45% of its own money, what we call equity. But a bank? Get this, a bank operates with just 8% of its own money. The other 92% is debt. And guess what most of that debt is? It's our deposits. This makes banks highly leveraged, which is a fancy way of saying for every $1 of their own money, they are playing with more than $10 of our money. It's an incredibly powerful way to make a profit, for sure, but it also means the margin for error is razor thin. So the bank you see on your local main street, that's really just one side of the coin. There is this whole other world of banking out there, a world that operates on a global scale with literally billions of dollars at stake every single day. And this really is the big split in the banking universe. On one side, you've got what you could call Main Street banking. These are the commercial banks, the ones that serve you, me, and small businesses. Then you've got Wall Street, the investment banks. These guys are advising massive corporations, handling multi-billion-dollar mergers, and trading super complex financial stuff. They're not just different, they're operating in two completely different realities. So think about it. We have this system that's built on a tiny slice of its own money, but it's absolutely crucial to our entire economy. With so much at stake and so much risk, who's watching the watchers? Who makes sure the whole thing doesn't just, fall apart? Well, that's where the central bank comes in. Think of institutions like the Federal Reserve here in the US. They're basically the bank for all the other banks. They're the ones setting the rules of the game. They manage the country's money supply to keep inflation in check. And, this is super important, they act as the lender of last resort. That means if a bank gets into deep trouble, the central bank can step in with emergency cash to prevent one bank's failure from causing a catastrophic domino effect. Okay, so that's the big picture. But what about our money? For you and me, the most important guardian is something called deposit insurance. In the States, it's the FDIC. What it does is guarantee that if your bank goes under, you will get your money back, up to $250,000. But, and this is a big but, you have to pay attention to the fine print. This covers your checking and savings accounts, but it absolutely does not cover investments like stocks, bonds, or crypto. It's a safety net for your deposits, not for your investment portfolio. All right, we've figured out what a bank is, we've seen how it makes a profit, and we've met the people in charge of keeping it all stable. So for our last section, let's put all these pieces together and answer the most important question of all. Why should you care? Why does any of this matter? You know, there's this old legal ruling from the 1800s that just nails it. It says that the second you deposit money, it stops being your money just sitting in a vault. It actually becomes the bank's money to use. In return, the bank gives you a promise, an IOU, saying we'll give you an equivalent amount back whenever you ask for it. And that simple transformation, that's the magic trick. That's what turns millions of separate little savings accounts into one massive pool of capital that can power the entire economy. So you can really think of banks as the heart of the modern economy. They're constantly pumping money to exactly where it needs to go. They take our short-term savings, the money we might need next week, and they cleverly transform it into long-term loans that people use to buy houses and start businesses. But here's the most mind-blowing part of the whole thing. Because of something called fractional reserve banking, they only have to keep a small fraction of your deposit on hand. This means that every single time a bank makes a loan, it is literally creating new money.
And that leaves us with one last kind of staggering thought. This ability to create money basically out of thin air just by issuing a loan, that's what makes the banking system the engine of our economy. It's what fuels growth and innovation. But as we've seen, it also creates massive systemic risk. So the next time you swipe your card or make a deposit, just remember, you're not just moving your own money around. You're actually a part of the system that creates it.